Speaking of creating wealth, it's no secret that the markets are jumpy. With European recessions, debt downgrades, presidential elections, and fiscal cliffs, there's certainly no shortage of events for investors to consider. And that has led to increased volatility both up and down. In this morning's U.S. Bank Economic 360, U.S. Bank investment analyst Jim Russell is joined by John List, a senior wealth strategist for U.S. Bank. They're talking about strategies to better steady investment values. Jim and John?
Thank you, Brian. Good morning, everybody. John, you're a wealth strategist for U.S. Bank, and you work with clients every day.
I do.
Tell us a little bit about what's on investors' mind regarding volatility in the markets. As Brian mentioned just a minute ago, it's not just the last week or two, it's not the last month or two, but it's really the last year or two.
That's accurate, and I think investors are kind of uncomfortable like Cincinnatians are recently with the weather. Kind of a similar correlation, makes you uncomfortable. And what I'd like to do is call up a chart here real quickly, and it shows the volatility in the market over the last 45 days. And what we're showing here is that there is 84% of these days that have had more than a 1% movement in the price of that S&P 500 index. This is the kind of chart that makes investors extremely uncomfortable.
Certainly looks like a ride at Kings Island or something, doesn't it?
That may be a chart you want when you're having an EKG, but it certainly isn't an investor's favorite.
Absolutely. So in terms of specific strategies that you bring to the table for our clients, what kind of thoughts do you offer?
Well, Jim, historically, this problem was much more easily resolved. An investor might simply reallocate their portfolio going from higher risk investments like equities or commodities and shift that into fixed income, bonds or cash. But as you know, U.S. Treasuries 10 years are currently paying only 1.6%, right. And quite frankly, cash is paying 0.
Right.
So those are not good alternatives for our clients or other investors. So Jim, we had to get a little bit more creative. So what we believe is at U.S. Bank that equities are still the place to be, but not without protection.
Understand.
So how do we get that protection? What we do is we combine a number of different strategies and investment pieces in order to come up with a situation where your portfolio or individual stocks have a floor and a ceiling. And quite frankly, we know there's no free lunch. So in order to have that protection on the downside, we have to put a ceiling on the amount of upside that we can participate in. Frequently, we do this with the more volatile asset classes, like commodities, small cap stocks, and international stocks.
Briefly, there's been a lot of wealth created in the tri-state area tied to local companies. We have a variety of wonderful companies, Procter & Gamble, U.S. Bank, Cintas, Kroger, a few of the others, Macy's. Can you speak briefly to maybe some strategies for a person who may have all of their eggs in one basket, a company-specific concentration?
Sure. As you mentioned, Jim, Cincinnati's been a hotbed for companies like this in creating wealth. And there's a couple obstacles that are out there that these people have that maybe others don't in order to protect their wealth. So we have to overcome that emotion. Yeah. And so what we do is we use strategies that, A, protect that value without making the client sell the security. Right. There is also a strategy that allows diversification without selling the stock. So there's a lot of opportunities we offer to clients with concentrated wealth.
Sounds great. Sounds like a lot of opportunity there. John, thank you for appearing this morning. Brian, back to you.
All right, Jim Russell, John List, we appreciate you and U.S. Bank.